Trading at Schwab is now powered by Ameritrade, bringing you an expanding library of education with even more ways to sharpen your trading skills. Access new online courses, insightful webcasts, articles, engaging videos, and more, all curated just for traders. Plus, guided learning paths with content designed to fit your unique interests. No sifting to find exactly what you need, so you can spend your time learning to trade brilliantly. Learn more at schwab.com/trading.
How many vendors does it take to meet all your organization's food needs? Just one. EasyCater, the workplace food platform that lets teams order from a huge variety of restaurants, over 100,000 nationwide, all through a single vendor. In addition to all that variety, EasyCater also gives you full visibility of your organization's food spend with invoicing, centralized reporting, and seamless integration with expense management systems, all on one platform. EasyCater, your business tool for food. To learn more, visit easycater.com/podcast.
Running small and medium-sized businesses is hard work. Business owners need to be sure their ads are working just as hard as they do. Amazon streaming TV ads makes your marketing dollar work harder. With Amazon ads, trillions of insights help small and medium businesses reach the right customers that matter. Your ads will show up during the shows the people are actually watching, and measurement tools show you what's working the hardest. Gain the edge with Amazon ads.
Bloomberg Audio Studios. Podcasts, radio, news.
This is a breaking news update from Bloomberg. Instant reaction and analysis from our 3,000 journalists and analysts around the world.
Welcome to the program. Equities recovering. There was a drop-off as soon as Chairman Powell started to speak. We're back to about negative 0.2% on the S&P. The bigger losses on the Russell, the small caps down by 0.8. In the bond market, off the back of these comments from Chairman Powell, bond yields higher at the front end of the curve by 9 to 10 basis points. A 25 basis point reduction from the Federal Reserve. Two-way descent. The limited ability to guide from here. And these comments from the Chairman of the Federal Reserve. Take a listen.
A further reduction in the policy rate at the December meeting is not a foregone conclusion. At a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
A December rate cut is far from a foregone conclusion. That was a prepared remark. It was scripted. TK, it was heavy with intent.
I love when they look down at the script. I mean, you wonder what percentage of the press conferences.
I think, to be honest with you, Tom, it gave it extra meaning. That was
absolutely.
The intent to come into this room and tell everybody, including Wall Street, we're not making a call on December.
Calm down. We're way down. And when we get to Torsten Slok, I want to really dive into that. I need to frame this, John. I think it's so important. We've had this spectacular move lower in the 10-year yield down to 3.9 whatever. OMG, we've come back 4.05% at 7-8 beeps move. It's only center tendency on two standard deviations. We're by no means, price has not cratered in the last 20 minutes.
Low end of the range for the year still. Yeah. Totally with you. Bond market's been super well behaved. When the Fed last met back in September, twos were near 350, 10s were near 4%. Right now, TK, twos near 360. Yeah. 10's near 4%.
There's going to be a lot of hyperventilation about this tomorrow. I'm also looking at the currency market, which I think is extraordinary, into the Trump-Xi meeting. And, it's a side story. I get it. It's not the Fed decides. It's maybe the president decides on trade. But it's a backstory to this that will be interesting the next couple days.
Dollar strength this afternoon. Euro dollar 115.82. Euro dollar down by 0.6%. TK mentioned it. Torsten Slok of Apollo with us around the table. Torsten, good afternoon. Good to see you. What's the big takeaway for you from that?
Well, that they do have clarity on the CPI, on the inflation side, but there was a lot of questions about the labor market, and it was very clear that he came into this saying the labor market is still chugging along, moving sideways, slightly cooling, and he didn't mention any of the private sector indicators, so he did basically say we don't quite know exactly what's happening in the labor market, but we still feel quite good about it. So that's why he came to the conclusion inflation is too high, the labor market is still okay. Therefore, there is no foregone conclusion about December.
How difficult is it to carry on cutting interest rates?
It is very difficult because the labor market does have a number of indicators that are very important for this discussion. There is, of course, ADP, which we just got, and thankfully now it's weekly. If you just think about the number, 14,000 was the average weekly number for the last 4 weeks. If you multiply that by 4, you get some estimate of what that means on a monthly basis. That means that monthly job growth at the moment is in round numbers around 50,000. We just got a Fed paper a few weeks ago saying that the new equilibrium rate for non-farm payrolls is 30,000. So by that measure, the labor market is actually strong. In other words, job growth is stronger than what the Fed itself thinks that it should be in the long run, because 50 is higher than 30. And the conclusion therefore is, now you suddenly have that both the labor market is actually doing a little bit better than expected, and inflation is still at 3, which of course makes it very difficult for them to begin cutting again in December.
Let me follow up on that, though. Is that politically acceptable to have a mid-100,000 number, 30, 40, 50,000? There's no way that plays in Washington.
Well, at least the Dallas Fed, who produced the number, had some very good arguments for that. There were 2 reasons why the equilibrium rate had gone down from 200,000 last year to only 30,000 today, which was immigration has been slowing down significantly, and the demographic headwinds also weighing on the overall number.
This is so important, and with your heritage, I think it really works out. What is the level or the new of their ex post right now? To me, they're almost redefining a way. Did you hear forward guidance in the press conference? I don't think that.
Forward guidance.
I don't think that.
In this environment.
Maybe backward guidance is the new phrase. Okay, paint the character, Dr. Slock, of our ex post nature now.
Well, the challenge also is not only did they not only mention forward guidance, but also he didn't talk about data dependent, because there is not much data. And if you say data dependent, that means that they're putting a lot of data on the private sector data. And he didn't mention some of the private sector data that actually is very important for the labor market. Not only ADP, there's also the, of course, Challenger Gray and Christmas job cut announcements. There's also a new data from Macro Edge that also looks at job cuts.
John, and you love ISM.
There is also the ISM data that still says that the labor market is okay. There's also link up job openings. There's also Indeed job openings. There's also Paychecks, which is also looking at employment. All these indicators combined still tell a story of the labor market actually still hanging in there. So it's not the case that the labor market is falling out of bed. It's still the case that the labor market is okay. And combined with inflation at 3, remember the Fed's target is 2. So inflation is still way above the Fed's target. There is just not room to cut rates more, in particular not, as he also talked about, if you begin to worry about if inflation expectations begin to become entrenched.
Torsten, what you're saying begs an obvious question. What I'm hearing from you is we've seen a step down in payrolls growth. We haven't seen an increase in labour market slack. Inflation is running at 3. Unemployment still close to 4. GDP's tracking around 3% at the moment in this country. If that's the case, why did they just cut interest rates?
Well, his argument was also very, very carefully articulated, namely that we are trying to get closer to our star. So it's back to this, peculiar interest in that there is some very academic Kalman filter you can do and figure out where is the level of interest rates where we should be, and say this was recalibrating monetary policy to that level. It really is a very, arm-waving academic discussion relative to what the actual data that you just listed. And if you add also the Atlanta Fed GDP now, almost 4% for last quarter. Where are we in terms of thinking about this slowdown? There is just not much sign of a slowdown when it comes to the real
Please
economy.
forgive the snark, but the way they talk about things like neutral and R-star, do these lights start flashing off in the FOMC room, in the boardroom, at the Federal Reserve? You've hit it. Well done, guys. Stop right there. What are they actually looking at to guide that decision?
Well, I do think that there is an intellectual camaraderie around R-star of saying, yeah, I know what you mean when you talk about R-star, and of course we've got to get down to R-star. But the interesting thing about also this is that if you really are saying at the Dallas Fed that there is now a 30,000 non-farm payroll level, that actually means that R-star is actually lower.
John, just Greg Ip has been wonderful about this. Where in God's name is the output gap right now? With Meta here in 25, 35 minutes, at Google, what we see tomorrow with Apple, Microsoft, the speech that NVIDIA gave the other day. Are you kidding me? We have no clue where the American output gap is.
Well, and that's why from a monetary policy perspective, it is really interesting, because if you look at the Magnificent Seven, they are all financed by equity prices being high. They're not sensitive to the Fed funds rate, whereas the S&P 493 is very sensitive to the Fed funds rate.
Is Apollo Global Management part of the Magnificent Seven?
They should be. They should be. Mike McKee was in the room. He was in the news conference. And Mike McKee, thank you for asking about financial conditions and financial markets. Mike McKee, what was the takeaway for you, sir?
I think the absolute takeaway is that the Fed is probably going to pause in December unless there's some data that forces them to do another cut. There was a sort of almost Freudian slip by the chairman close to the end of the news conference when he said, if we cut again. And then he quickly backtracked and said, we will at some point. But I think that the mood of the committee now is we've done enough. Let's sit back and see what happens, especially without any data. And given the fact that inflation is still rising, you noted at the beginning when he was giving us the rundown of the economy, he said extrapolating the CPI into PCE suggests that it rose at 2.8%. Well, it was 2.7% in the prior reading. So it just shows you that inflation is still rising at a time when he had a hard time making a case that unemployment is a real problem. So I think the takeaway is don't expect much from the Fed in December unless the government gets back to work and we get some data that change their mind.
Michael McKee, you have covered the Federal Reserve for decades. Volcker through Greenspan, Bernanke, Yellen, the likes of Chairman Powell. Mike, is the era of almighty Fed chair dominance and power on the committee, has it come to a close?
Well, I think that's another way of saying that I'm old, John, but I don't think it's come to a close. It's just changed a lot. When you had Paul Volcker, he was very firm in what he wanted to do, but he came in during a crisis, so he was able to marshal the troops to do that, and then they rebelled against him. Greenspan did it differently. He ran the Fed as if it were his own, and they did what basically he wanted them to do. But starting with Ben Bernanke and following with Janet Yellen and Jay Powell, it's become much more collegial. And the chair now is more in a situation where they are taking the temperature of everyone there and trying to figure out what the best consensus move would be. And I suspect that that's what members of the board and the Open Market Committee would like to see happen going forward. Don't know, given the names of various people who are among the finalists to replace Jay Powell, whether we would have an attempt to go back to the strong chairman view or whether we would still continue with consensus.
Can they wrestle control from that committee? Mike, thank you, sir. Fantastic work. You're not old. You're brilliant. Mike McKee there in Washington, D.C. Appreciate it. You're brilliant too, TK. You know there's love. Come on, there's enough love to go with. But yes, maybe a little bit. More than me. Torsten, you're still with us. Torsten's Lock of Apollo, by the way, if you're just joining us. Torsten, Bob Michael of JP Morgan was on the programme with me and TK earlier on this afternoon, and he made the case, after this decision dropped and we saw the two-way dissent, that the chairman was losing grip of this committee. What's your take on that?
Well, it is a very unusual situation to have someone on the committee that thinks that rates should have been on hold, meaning that it go in other direction than other members here, in this case, Steve Miran, who thought that they should have been cutting. So it is a very challenging environment, of course, for whoever is the Fed chair and whoever walks in to be the next Fed chair to try to get a consensus on the committee. There is so much work that goes into, from the chair, whoever it is, to try to get a decision that is unanimous and that is a common ground and saying this is the way we're walking and this is the direction we're traveling. Now that there's more uncertainty about this, one reason why rates are going up is also because, well, maybe now Schmidt is not the only dissent. Maybe there are others that come around next time and say, well, maybe we shouldn't be cutting, or maybe there might even be someone who says maybe we should be hiking. So that's why I do think there was already a dot in the dot plot last time that said that rates should be going higher in December.
I think we know whose dot that was.
And now we know that was Schmidt from the Kansas City Fed. So yes, it is becoming a much more challenging exercise. Normally, we just talk about inflation, unemployment, but this is no longer just about inflation, unemployment.
The heart of this, we got to get to Rosenberg, but the heart of this, John, is he's lame duck. That's all there is to it.
Totally agree, TK.
It's October. He's supposed to begin to be lame duck.
So let's fast forward to December. Just think about for a moment how much harder that's going to be. Put out forecasts, probably know who the new Fed chair is. How much power is Chairman Powell going to have at the December meeting, knowing who his replacement is potentially once we come around to May?
Yeah, I agree. And of course, as we've said 3-4 times today, not me, but others are saying the Secretary of Treasury could be involved as well.
Jeff Rosenberg of BlackRock's running. Jeff, welcome to the program. I won't mention Rick. We'll leave that to one side. We'll keep you in, good company over at BlackRock. I'll keep you out of trouble. What about it? No, Jeff, seriously. Great. Jeff Rosenberg, number one takeaway from that decision this afternoon and that news conference too.
Yeah, I mean, the number one takeaway is the comments on December, the comment on slow down when you're driving in the fog. It's interesting you guys were picking up on him reading in the notes and whether that was, very much pre-planned. I think what you see here is a repricing of market pricing to December. Going into this meeting, it was basically a foregone conclusion. It was 100%. When you come out of the meeting and you see the dissents on both sides and you recall the division within the committee, you could say that is an appropriate repricing to the really realization that there's more two-sided risks to the Fed's decision than the market was pricing in it. And perhaps that comment was engineered to kind of push that forward. Maybe it wasn't, but the reality is that's what the market reaction is. And you can see that that's, a very reasonable reaction to what we saw from the committee today.
I'm going to do an audible here. We got Torsten Slok and Jeffrey Rosenberg with us, and that is good and wonderful with their financial and economic knowledge. Torsten, you have a blistering sentence in your note of your concerns over private credit. I would suggest for global Wall Street, into the next Fed meeting and beyond, there's going to be further challenges here about the opaqueness in private credit. With all of your resources at Apollo Global Management, how blind are we to where we're heading in the pricing of private credit?
That discussion is totally misguided. In public markets, I can get something that's safe. I can get something that's risky. In private markets, I can get something that's safe. I can get something that's risky. So there is no difference. It really is all about, do you want a risky investment? Do you want a safe investment? Something in the public market is investment grade, something in the private market is investment grade. So this discussion around what's happened in the last few weeks, yes, there might be a few cockroaches in the sense that there have certainly been some things that have been going under. But interestingly enough, those were basically all broadly syndicated loans. Meaning these were things that were trading tick by tick, minute by minute in the public market. So why is the discussion about what's happening in private credit relevant for this? These were cockroaches in the public market that showed up in public balance sheets.
Jeff Rosenberg, will this affect the Fed? I mean, it's just as simple as that. If we have Wall Street instability and fear about this with all your work at Carnegie Mellon, can they ignore those cockroaches?
Well, it gets back to some of the earlier comments about, the questions that he got on financial conditions. Yes. And, to what extent does financial conditions sort of factor into the Fed's decision? And I think what we see is an asymmetry here, that financial conditions aren't really factoring into their decisions to cut rates here. Financial conditions, you saw him parry the questions around interest rates and AI, basically, brushing them aside, saying AI financing has nothing to do with rates, which is true on a first order effect, but not necessarily on the second order effect, to the extent that interest rates broadly are creating very easy financial conditions, and they're contributing to the increase in financial conditions easing, especially that we saw since the Fed pivoted, to the labor market slowdown. That took us from, measurements that were sort of more optimistic to measurements that were kind of more on the euphoria side. But I think the asymmetry here is that the Fed will respond to tightening financial conditions after they're realized. To the earlier, interchange on, ex post and data dependence. This is a Fed that will be reactive. And I think what's very clear is the Fed's not really paying a lot of attention to financial conditions going into this cycle, but they will, as they have been, ever since the GFC, that they'll be very responsive if financial conditions for things that have nothing to do with the Fed end up tightening. The Fed will react into that with a massive cut in interest rates, restoration of zero interest rates, the forward guidance that you just talked about, balance sheet, all the tools that were once thought as kind of not normal are part of the normal playbook, but they'll be in reaction to something that is outside the Fed's control here and a tightening of financial conditions.
Jeff, is that still a green light then? A bright green light just to stay long risk, stay long equities?
Well, it's a light that says you can't really predict that on a directional basis. The Fed is supportive here. That's part of, again, what we saw in kind of the movement in the metrics from optimism to euphoria around August, September. And the Fed's continuing to send that signal with market pricing coming down a bit, but basically pricing to normalization of 3%. And the expectation that under any circumstance where the Fed is faced with an outsize. And you heard in that last question right at the end, the Fed talking about the impact on consumption. this is understated. I mean, he said it in a very small way, but a large shock downward has a significant effect on consumption. And what was a little bit understated here is that the large increase in the wealth effect has been the support for consumption. It is why we're surprisingly strong. In addition to the lagged implementation and tariff inflation not being as worrisome, it was really the surge in the wealth effect and consumption that's leading to the upside surprise. But that has a double-edged sword to a larger decline. And that's, I think, the concern around financial conditions tightening.
Jeff, before you go, I promised I wouldn't mention Rick, but I think it's worth it. You know, I've known Rick a long time. You've worked with him a long time. Can we just spend a second or something? Just how cool is it that Rick Rieder's name is associated with the Fed chair position?
It is very good for you to talk about that, and I look forward to hearing more from you on that subject, Jonathan.
Okay, Jeff Rosenberg of BlackRock. You avoid it, Jeff. You avoid it. I think it's fantastic.
I did.
To have someone like that.
To have the mix, absolutely.
It just makes the process all the more credible, which I imagine was the objective of the Treasury Secretary.
Mr. Rieder brings an entrepreneurial sense here that you don't get from grizzled economists. And
understands
the
this market.
The president is to be hugely lauded for that with his secretary. Can I point out in the time we've got left something back to the late July meeting?
Sure.
Google, who we're going to hear from in 45 minutes, is up 42%.
Not bad.
We have to remember, I'm talking about the food lines in Chicago with Diane Swang. The roulette wheel is in full spin right now.
We've got about 60 seconds left. Programs like these traditionally obsess over what can go wrong. Torsten Slot, can we finish on what can go right? You put out a fantastic note in the last month about the economics profession needing to take a long, hard look in the mirror and just think about where we are compared to where they thought we would be, which is in a much worse place.
Absolutely. So the key issue was that Liberation Day is now 7 months ago. And we are still having a Fed chair that talks about the labor market is actually doing quite well. And we still have inflation above the target. I think that we have all been surprised. And of course, the market has been surprised. And the economics profession has definitely been very surprised that the textbook would have predicted a much more stagflationary shock, much more upside pressure on inflation, much more downside pressure on GDP. We have not seen that. And some would say yet. But this is the discussion, namely, do we still have that, as you just said, as a lagged effect in front of us? Or is this it? And then things are only getting better from here. And this is why what the Fed was doing today was exactly to say, so far, we have not seen that stagflationary shock that we expected in April after Liberation Day.
TK, we've been saying yet, it's not happened yet, for a long time now, a number of years.
We have. We got to get the shutdown finished so we can get the data, because we're all blind. That's the number one thing.
Right now, we're waiting for earnings. An interesting meeting in the last hour or so. Torsten Slot of Apollo. Torsten, thank you, sir. The Federal Reserve reducing interest rates by 25 basis points. Dissent to both sides and a very, very limited ability to guide beyond this meeting into December. Equities attempted to turn around. The opening bell behind us, the closing bell 15 minutes away, and a ton of earnings still to come. From New York City, good afternoon.
How many vendors does it take to meet all your organization's food needs? Just one. EasyCater, the workplace food platform that lets teams order from a huge variety of restaurants, over 100,000 nationwide, all through a single vendor. In addition to all that variety, EasyCater also gives you full visibility of your organization's food spend with invoicing, centralized reporting, and seamless integration with expense management systems, all on one platform. EasyCater, your business tool for food. To learn more, visit easycater.com/podcast.
This podcast is brought to you by FedEx, the new power move. Hey, you know those people in your office who are always pulling old school corporate power moves? Like the guy who weaponizes eye contact. He's confident. He's engaged. He's often creepy. It's an old school power move. But this alpha dog laser gaze won't keep your supply chain moving across borders. The real power move? Having a smart platform that keeps up with the changing trade landscape. That's why smart businesses partner with FedEx and use the power of digital intelligence to navigate around supply chain issues before they happen. Set your sights on something that will actually improve your business. FedEx, the new power move.
Mint is still $15 a month for premium wireless. And if you haven't made the switch yet, here are 15 reasons why you should. 1, it's $15 a month. 2, seriously, it's $15 a month. 3, No big contrast. 4, I use it. 5, my mom uses it. Are you playing me off? That's what's happening, right? Okay. Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan. $15 per month equivalent required. New customer offer first 3 months only. Then full price plan options available. Taxes and fees extra. See mintmobile.com.